finished chapter 15 in Business 210, Principles of Management online with Professor Joe Lane. Still getting used to this online delivery sort of thing, but I'm enjoying doing the videos. I just like to say I'm in the room we normally teach in, so I'm just pretending y'all are out there. Okay, we finished chapter 15. And now we're getting ready to hit into the very last chapter. This is a chapter we've been looking for the whole time. This is the one chapter that our author has on control. Plan, organize, lead, control. Just one chapter, but I think it's a really good chapter. I think it covers a lot of stuff. There's some really good material in this chapter, and we're going to talk about. Now, this is 14, 15, and 16. So what we're going to do is, after this chapter, these are the chapters 14, 15, and 16 that make up a great deal of your final. Now, you know your final is comprehensive, so it goes back from chapters 1 through 13 as well. So right now I'm going to do chapter 16. I'll tell you the no's and to be familiar with in chapter 16. We'll shut down chapter 16, and then on the next video, what I will review, I will review for you the final. I'll review for you chapters 1 through 13, which you either know or need to be familiar with. Well, I hope you're doing well. So let's get started in chapter 16. Chapter 16, as I said, control systems and quality management. And it's mostly about control and control systems. So these are my notes. In the 8th edition of the text, the author changed some things around. In the 7th edition, he started with what I have at the top of the notes and then went from there. In the 8th edition, which is the edition a lot of you have, he started talking about first control, and then this top part up here he did towards the end of the chapter. So I'm going to start midway down on this page, and then I'll catch this top part kind of as the last. Okay, control. Businesses have objectives. A department has an objective. A division has an objective. A store has an objective. A region has an objective or objectives. A company has objectives or goals. You've got to be headed towards accomplishing those goals. That's what it's all about. If you accomplish the goals, then you are accomplishing your mission, your purpose, and you're moving in the direction you need to move. Well, if you get off course, that becomes a problem. So that's what control is all about. It's keeping you on course towards, you do a lot of control yourself. A lot of you are working, you're very involved with family, you've got school, you've got a number of things. So you got to keep all that stuff under control. You got to make sure that you take care of family stuff, you make sure you got to take care of work stuff, you got to take care of school stuff, and I know there's other stuff. You got to make sure it heads in the right direction. Same thing with a business. Okay, let's look at first what is control, since control is the big word in this chapter. Control is defined as monitoring performance. How's everybody doing? How's the department doing? Comparing it with goals. Here's the performance we have. How is that performance that we're currently doing going to help us? Is it going to help us meet our goal? And taking corrective action as needed. So controlling is defined as monitoring performance, comparing it with goals, and taking corrective action as needed. We want to make sure that performance meets objectives, that the performance that's going on within the company or within your department is going to cause your objective or your goal to be met. So that's kind of the idea. Of what control is. All right, now, I'd certainly be familiar with what control is, and also be familiar with why is control needed. Now, I think I put in your handout for these chapters, I put a sheet right out of the book that talks about why control is needed, and we went down through we went down through several things here as far as, you know, within a company. See if I can get on this chair. All right, I got it. Why is control needed? Let's look at those, and I'd be familiar with these. And I'm just looking at it right out of the text, the page that I gave you in your study notes. Number one, to adopt to change and uncertainty. If you've got things under control, you know where you are, you know where you're going, it's much easier to adapt to change. And it's much easier to face uncertainty. Number two, discover irregularities and errors. If you're paying attention to what's going on, it's easy to discover irregularities, error. Hey, that's not right, whatever. Number three, reduce cost, increase productivity, or add value. As you've got things under control, in other words, when you're watching things and you're monitoring things, then you may see opportunities to reduce costs. You may see opportunities to increase productivity, that sort of thing. Detect opportunities. Number five, deal with complexity. There's always a lot of complexity going on. Number six, decentralize decision making and facilitate teamwork. The whole idea here is these reasons why control is needed just explains that control is such an essential part of what managers do. You can plan, you can organize, and you can even lead, which is great. But you got to be planning and organizing and leading in the direction that will allow you to accomplish your goals. So these are just 6 reasons why you need control. Whether those reasons be to deal with complexity or to deal with uncertainty, whatever, but I'd just be familiar with those reasons. Now, steps in the control process. You probably guessed it. That would be a no. That would be a no. What are the steps in the control process? Step number 1, establish standards. Where is it I'm trying to go? When you establish standards, what that's saying is, if I accomplish this, 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 and this, if I do this, 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 and this, I'm going to be able to accomplish my goal. So this, 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 and this are standards. If I meet these standards, I can accomplish my goal or objectives. Control starts with standards. If you ain't got no standards, you ain't got no control. Because you can't control when you don't know where you're going. You can't control when you don't know what you expect. All right, so here we go. I'm sorry, got a little too carried away with that. Steps in the control process. Establish standards. What are the standards for my store, for my region, for my department, whatever it is? Number 2, measure the performance. How is the performance of this individual? How is the performance of my department compared to the standards? Step 3 is just that, compare performance to the standards. Step 4, take corrective action if necessary. If you don't have to take, if everything's going great, should you tell them it's going great? Sure, encourage them. That's a motivating thing. Hey, you're doing great. We're going well. As a matter of fact, we're even doing better than we should be doing. That's exciting. But if you're not, when you compare your performance to the standards and you're not meeting standards, take corrective action. Whatever you need to do to make sure that you get back on standards to be able, and accomplishing standards so you can meet your goal or meet your objective. Okay, so I would know the steps in the control process. You know, when we talked about organizations, let's just make this a company. I'll do it this way. Up here was strategic stuff. Here was tactical stuff. Stuff was not the official word. And I think down here was operational stuff. Okay? So the question is this. Where should you have control? Should control be at this level? Yep. Should control be at this level? Yes. Should control be at this level? Yes. So I'll put you a little note here. Levels of control. At all the levels within the organization, you've got to have control. It's just like we talk about other things. Where do you need leadership? At all the different levels within the organization. Same thing with control. You need control with in all the different levels within the organization. Okay. when we talk about control and talk about trying to make sure that you are meeting standards and putting controls in place to see that you're able to meet standards. Some of the most important controls that you can have, and I'll just sit them right up here, are financial controls. Yeah. So if we look at the handout, now the top part of that, the back page, the top part of that talks about 3 techniques to help establish standards and measure performance. We'll kind of skip over those. Those 3 techniques are fine. I would say that 99 times out of 100 in your career, you're never going to see any of those 3 standards. You may, or any of those 3 techniques. So I don't want to get to those because you may or may not see those. But financial controls you're going to see. Financial controls are utilized in every organization, whether it's a goods producing organization or service producing organization, whether it's a profit, a non-profit, whatever, you're going to see financial controls. Okay, probably the most number one-est control are budgets. You may have a personal budget yourself. You budget the income you're going to get, and you budget your expenses. And the idea is, with this amount of income, here's the expenses that I'm going to have, and if I live within my expenses and I receive the income I think I'm going to receive, then I'm going to be able to do fine during this period of time. Maybe your budget is for a year. And maybe you budget some things that you want to do. A new set of tires, a vacation, something like this. Well, within businesses, the same thing is true. Budgets are very, very important for control. And budgets is a formal financial projection. You are projecting in a business, your revenue, you're projecting your expenditures. And what you're saying is, if I expend my funds that I'm going to receive in this way, I'm going to accomplish these financial goals, and I'm going to accomplish these company goals and objectives. Okay, so I'd just be familiar with what budgets are. It's a formal financial projection. Now there's 2 kinds of budgets. There's fixed budgets and there's variable budgets. So let's just talk about that for a second. A fixed budget is a budget where once you set that budget, you don't change it. If you set that budget for a year's period of time, you don't adjust that budget at all. It's fixed for the year, or it's fixed for a particular period of time. A variable budget is a budget that you may change over time as things occur. All right. Matter of fact, let me look right here. When we're talking about budgeting, I've got my textbook. My textbook's fairly close, and when he's talking about budgeting, if I can locate that for us, it's a formal financial projection. And then he talks about fixed budget allocates resources on the basis of a single estimate of cost. A variable budget allows the allocation of resources to vary in proportion with various levels of activity. Well, I probably shouldn't have read that. That probably probably confuses us more than it helps us. But let me kind of give you an example. If you budgeted in your company this year, now you have a lot of vehicles. You do a lot of, maybe you do road construction, or things like that. So you use a lot of gasoline. So you've budgeted for the year X number of dollars for gasoline, and you budgeted that gasoline at $2.85 a gallon. Okay. Well, right now, as I was coming to work this morning, this will kind of tell you, if you're watching this video in 2025, you'll kind of know when this video was done. When I came to work this morning, the lowest I found was $1.39. So if you had budgeted your expenditure for gasoline at $2.85, might you want to adjust that? to be more reflective of what it really is? Well, the answer is yes. So anyway, way too much on that. Fixed budget is a budget that it stays fixed. The costs that you predict are fixed. Variable budgets is where you can adjust it. I think variable budgets are much better. They're much more realistic. All right. Along with budgets, and remember, you budget revenue and you budget expenditures. Along with budgets, there are financial statements. If you've had Accounting 201, you know all about financial statements. If you've had Business 101 with me, Chapter 17, Accounting chapter, you know a little bit about financial statements. A financial statement is a summary of some aspect of an organization's financial status. That's kind of what we put in our handout here. Financial statements, a summary of some aspect of an organization's financial status. Okay. So financial statements are about financial stuff. The two biggest, most important financial statements are a balance sheet and an income statement. Now I'm just looking at my handout here. A balance sheet shows the overall financial worth of a company at a given point in time. What is the worth of a company in a given point in time? Remember, in a balance sheet, you have assets, liabilities, and you have owner's equity. Here's the assets, the stuff I own. Liabilities, here's the stuff that I owe. Owner's equity is worth, that's my worth in the business. Or that's what the business is worth. Okay. So a balance sheet shows you your overall financial worth. The income statement shows the results of operations over a period of time. An income statement has in it revenue and expenses and then net profit or net loss. So an income statement tells you, how did I do last year? I had this much revenue, I had this many expenses, I had a net profit of this, very good. So it's a different statement than a balance sheet. An income statement tells you the results of operations. The balance sheet tells you your financial position at a given point in time, like in a particular day. But one affects the other. If you've got an income statement that's consistently showing profits, you're probably going to reflect a balance sheet that's going to continue to have more and more worth to it, or owner's equity. But you can study and you can look at that balance sheet, and you can look at that income statement, your revenues, your expenditures, and that sort of thing, and it helps you control, because you see where you've been when you look at those two statements. So I'd be familiar with what a balance sheet is. I'd be familiar with what an income statement is. Now, I went crazy on those, but I'd just be familiar with the fact that a balance sheet shows the overall financial worth of a company at a given time, and an income statement shows the results of operations for a period of time. Those are the big things as far as financial controls. They're not the only ones. You know, there's cash flow statements, and there's all kind of stuff. But the biggies are budgets, income statement, balance sheet. You can tell a lot about how your company is doing, and you can project how you want your company to go with a budget. So those are very important financial controls. Now, our author jumps now into something else about, I don't know if he does it because it should be in a control chapter, or it's just something he wants to mention before he gets through. And he talks about total quality management. I guess if you manage for quality, I guess if quality is very important to you, and you know, people want good quality. So I guess if quality is important and you manage for quality, that's going to certainly help you as far as control, certainly in control of your product, your good or service that you're turning out. So I'd be familiar with what total quality management is. It's a comprehensive approach. That means comprehensive means it's throughout, dedicated to continuous quality improvement, training, and customer satisfaction. So I think that if you want to accomplish your goals and objectives, utilizing what they call TQM, total quality management, a comprehensive approach dedicated to continuous quality improvement. Do you want to continually improve your quality? Yes. Training, should you always train? We know the answer is yes. And customer satisfaction. So if you're looking at improving your quality, training your folks, that helps to improve your quality, by the way, and customer satisfaction, you're going to go a long way towards being successful, and probably a long way to making sure you're controlling yourself to go in the right direction. Down at the very bottom of the back side of my page, the way I have it, oh, by the way, I'd be familiar with what TQM, or Total Quality Management, is. There's two things at the bottom that I would be familiar with on the back side. Then we're going to flip back to the front and get it. The keys to successful control systems. You have different control systems, whether they're budgetary systems or they may be other types of systems to control your output, systems that control your machinery system, you know, whatever it is. He says the keys to successful control systems. All right, let's see what they are. There's 4 of them here. They're strategic, that means they're important, and they're results oriented. Control should be built around results expected. Number 2, they're timely, of course, accurate and objective. That's almost self-explanatory. They are realistic. You know, remember, control starts with standards. If your standards aren't realistic, you're not going to be able to have control. They should be realistic, positive, understandable, because remember, you may be setting up the standards, you may be setting up the control systems, but who's going to have to follow them? Your employees. They've got to be understandable. And they should encourage self-control. They should be set up in such a way that employees want to control their operations, their self. And number 4, they have to be flexible. Sometimes controls need to be changed. So I'd just be familiar with these keys to successful control systems, and then I'd be familiar with the barriers to control. Hey, we know what the keys are. What are the barriers? Too much control. You can't control everything. What do you control? You control the important stuff. You know, there's been several books written, you know, concerning things about how we are individually, you know, like don't sweat the small stuff. We get so bent out of shape sometimes over the small stuff. And we need to just relax over that. You know, we need to concentrate on the big things. And that's what he's saying here. Too much control. Control those things are most important. You can spend more money and more time and more effort controlling things that even if it went out of control, it wouldn't be as costly as your control system. Number 2, too little employee participation. Like we said, who's going to be doing this stuff? Employees are. You've got to get them involved. Number 3, overemphasis on means instead of ends. You're concentrating on the goal. You're concentrating on the objective. That's what you're looking at. So make sure that what you do is going to accomplish the goal or objective. Number 4, overemphasis on paperwork. People don't like paperwork. Minimize the paperwork as much as possible. And number 5, overemphasis on one instead of multiple approaches. Okay, you don't want too much control, but you got to have multiple. You have to have multiple approaches to control. You just have one humongous control system because different things need different types. All right, so I'd be familiar with the keys to successful control systems, and I'd be familiar with the barriers to control success. Now, let's go back to the top of this page and finish up this chapter. In your text, if you're in the 8th edition, this is towards the last of chapter 16. If you're in the 7th edition of this text, this was at the very first of the chapter. I liked it a whole lot better at the very first of the chapter because I thought it was a great lead-in to talk about control. Okay, so here's where we are. Our author says, what's management's purpose? What is the purpose of a manager? Well, they plan, organize, lead, and control. Yeah, I know that, but what's their purpose? Well, their purpose is to make things happen, to lead their employees. Yeah, I know, but can we say it a little differently? And look what our author, look what he says here at the very first now, chapter 16. A manager's purpose is to get the people reporting to them to achieve productivity and realize results. Now, realize results is almost another way of saying accomplishing goals. But don't you like? I like that. I really do. What do you want your folks to be? You want them to be productive. You want them to be productive. Why? So that they can achieve results. I just think that's really good. All right. And so then he goes on a little bit further along. And by the way, there is a great. It's not anything to do with. This is not going to be a testable item. By the way, I do want you to be familiar with what the manager's purpose is. But I put on your handout managing for productivity. I put that in your study notes. And this is where it has, the purpose is to get people reporting to you to achieve productivity and realize results, which we were just talking about. But I love this figure 16.8 here. Now, it's not going to be on a test, but I'm going to talk about it a little bit because I want to, and I think it's important. It kind of summarizes a whole lot of what we've done this whole semester. Here's what it says. You are a manager. So consider yourself a manager. I'm at least a middle-level manager. All right. You are a manager. You must operate in a complex environment. You operate in an environment where you have to have a competitive advantage. You operate in a global environment. You operate in an environment full of diversity. You operate in a very information technology-driven environment. You operate in an environment of changing ethical standards and the importance of ethics. You operate in an environment of sustainability. You want what you do to be there for your kids and your grandkids. And you do all of this with happiness and meaningfulness. You want to be happy. You know, find a job you love. Find a job you love. Find a job you feel like you're making a difference. So you are operating in a very complex environment. And in operating in this complex environment, you're making decisions about how to plan, how to organize, how to lead, and how to control. Those 4 things you do. Why are you doing all this stuff? Why are you doing all this planning, organizing, leading, controlling? To achieve productivity and realize results. Isn't that a neat chart? That's really a neat little chart. And again, it's not testable, but if you want to kind of summarize in one little chart, what do managers do and why and how? That's a great little chart to have there. Okay. Now, he talks a little bit about what is productivity. He defines productivity as outputs over inputs. The outputs that you have over the inputs that goes in. Now, we can understand that. Outputs are results. Outputs are what we do. Outputs are what we accomplish. It's the number of the product that's produced or whatever. Inputs is what it takes to produce it. If you can lower the amount of inputs you have to have and increase your outputs, that's super good. So productivity is outputs divided by inputs. Or he breaks it down a little bit further. Productivity is goods and services. See, that's your outputs, either goods and or services. The inputs that you have are labor, capital, materials, and energy. You have that, I think, on your handout. Yeah, you have it on the. Excuse me, didn't mean to leave. You have it on the handout that I gave you with the study guide. But I would be familiar with what productivity is. Outputs divided by inputs, or, now you're not going to be writing this, you're just going to be familiar with it, are goods and services divided by labor, capital, materials, and energy. Now, so here's the deal. Let me say it one more time. If you can take the amount of labor, capital, materials, and energy that you have, energy could be electrical energy, it could be whatever, and you can increase your goods and services, you've increased productivity. If you can decrease the use of this, and still maintain the same level of goods and services, you've increased productivity. And wow, if some way you can figure out to decrease this and increase this, you've really increased your productivity. So I think that's pretty neat. So chapter 16 is the chapter about control. Again, I'd be familiar with what productivity is. I'd be familiar with what our manager's purpose is. I really did like that. I think we've covered chapter 16 pretty well. Control is important. And one of the big, planning, organizing, leading, control is essential to make sure that your department, your company, or whatever is going in the right direction. I like to control people. That's not the idea. Control should be looked at very positively. You want control. Your employees want control because they want to make sure that they're successful. And that's what control does. Make sure you're moving towards your goal or your objective. All right, that is chapter 16. I'm going to go study a little bit. come back, bring my book back, and we're going to go and we're going to do kind of a review for the final. And again, chapters 14, 15, and 16, we've already done those. You've got to know and to be familiar with, but I'm going to need to go back to chapters 1 through 13. So you know how we do this. So Professor Pierce knows that I have finished a chapter. We do a very loud clap, and then he knows I have finished something, and he knows there's a good breaking point, so he doesn't have to search so hard for it. So thank you. I've enjoyed being with you in Control, chapter 16. We're going to shut this thing down with a loud clap. Thank you.